We're looking at China being in deflation today after their really quite bad inflation numbers were released overnight. And then we're going to move on to the initial jobless claims out of the US to see whether these will finally put a cap in any hike potential next year for the US economy. And then the trading takeout today will be on whether the death cross is a valid indicator or trading strategy at all. Now, the only way you can get the best trading insights, education, and analysis each day is if you're here every day. So hit subscribe so you can get your daily trading edge. So Chinese inflation data has come out overnight and it's been found to be at negative 0.2% versus the expected of negative 0.1%. So that's a miss, basically, a negative miss. You know, it was worse than expected. So China is firmly in the grips of deflation. Now, this is likely to have widespread effects on quite a few different commodity markets, I think. You know, China's a huge economy, massive demand sensitivities there to different types of commodities. But the one I want to focus on is gold, because there's been a lovely reversion in the price of gold, and we're now trading through the 200 daily moving average as well. We traded through that this week. And this number should be, in terms of the inflation number, should be quite bearish for gold, in my view. If you think about it, you know, if inflation is ticking up, then you would expect prices to also be increasing. You know, people want to increase prices as a business. It makes sense to, because you're expecting growth to be increasing and therefore incomes to increase as well. However, if those things are not occurring, then the price should decrease, and gold is a huge input in lots of different things, you know, whether it comes down to electronics, whether it comes down to, I guess, you know, any components in electrical devices. Effectively, it's used everywhere. Now, there's quite a nice relationship here then between Chinese demand and demand for gold as a commodity from places like Australia, for example. And we can maybe look at the Aussie dollar in a second. But gold, I think, has a nice little reach down here to about 1917-ish, let's say at 1915. I think this is the trend set now. And we can see that, you know, when it tends to come under the 200 daily moving average, it stays there for a reasonably long time, even the most recent move down from the same position. By the way, if we draw it up here, you know, we found resistance up here at the same numbers, and then we've pushed down below the 200 daily moving average. It's reasonable to argue then that we're going to have a similar move here. Do you see where I'm pointing there? So this is sort of where I'm looking. And as I always say, nothing good happens under the 200 daily moving average. So I'd argue that the short-term direction in gold is set and probably dictated here heavily by what the Chinese data is saying. Now, if we move over onto Aussie dollar, we can see that there's sort of a similar relationship. You know, we've seen gold fall off just recently and also the Aussie dollar fall off. It's been trading under the 200 daily for quite a long time now. However, the one thing I would say is that if that Chinese demand does falter a little bit more, and if the RBA, the Reserve Bank of Australia, does decide to become a little bit dovish, I would see this completely tumble, in my view. It's being buoyant right now because of some equity strength, some risk on behavior, but I would say that there is the potential for the Aussie to follow through like gold as well, considering they're so intrinsically linked by Chinese trade. I've been battering on for quite a long time now about how I reckon the US employment situation is really the big sort of data point to fall in the US to create any sort of issues. Excuse me. We're seeing the housing market and property markets come down a tiny bit because of the interest rate hikes. But what we aren't seeing is the employment status of Americans, and more generally across the globe, actually. We're not seeing that employment status really deteriorate. Today, we've got the initial jobless claims, which, you know, you can see here, the expected number is 218,000. The previous was 217,000. For any real risk weakness to enter the market, I think we need to start seeing blowout numbers here. And I don't think we're going to get that purely because the NFP last week was softer, but it wasn't like really, really poor. Do you know what I mean? It was still okay, especially for where we are in the rate hike cycle. It seems like that Phillips curve relationship of higher interest rates, lower unemployment higher interest rates, higher unemployment is completely broken. So, my number one piece of advice now is to focus heavily on the macro side of where employment is headed, because I think that is literally the final piece to come together for any real broader risk weakness. And it's the key way to protect your portfolio, not just your trading portfolio, but your more passive stuff, your pensions, for example. It might just mean that you rejig things away from risk, maybe over to bonds a little bit more, for example, or even just sit in cash, throw it into an MMF. But this is the way that I'm viewing the economy from here on in, and its relationship to the financial markets is heavily, heavily correlated to whether unemployment deteriorates quickly. So you might hear a lot about the death cross and maybe the golden cross quite a lot in trading circles. I'm going to focus on the death cross today. Is it a good indicator? Well, I don't really think so. I think that it's overcomplicated and you can actually simplify it much more by using just a 200 daily moving average. But firstly, what is the death cross? The death cross is when a faster moving average crosses below a slower moving average. People tend to think that it means that there's going to be a broader market decline. But if we take the example of COVID, March 2020, the death cross occurred and it basically timed the bottom of the market. So you would have lost money. Over the years, what the death cross combined perhaps with the golden cross is able to do is to effectively limit max drawdown. But as I mentioned at the start, you can kind of do this just with a 200 daily moving average strategy. If the market crosses below the 200 daily moving average, you exit your position. When it goes back up, you enter. And you can do this over and over again until you actually jump onto that trend, which does trade well above the 200 daily moving average. Should you therefore use the death cross? I don't know. If you are able to develop a method of being in the market less because of it, and it comes out of a positive return, then fantastic. But I think with everything to do with trading, it's about interpreting what is going on and understanding that any lines that you draw on a screen is just a tool to facilitate your decision making. That is it.